Welcome back, everybody, to another deep dive. Today, we're going to be talking about building generational wealth.
Ooh,
Yeah, I'm excited for this one.
me too.
Generational wealth, we're not talking about just getting rich quick. This is about lasting financial security that can benefit you, your children, your grandchildren.
Mm,
And I'm excited to unpack this because, honestly, even though we all deal with money daily, it can feel like this big, mysterious force, right?
absolutely. And I think that's where a lot of the struggle comes from. We're told to save, to invest, but often the why behind it gets lost. It's more than just numbers in an account. It's about understanding how money plays a role in a truly fulfilling life.
I love that. Fulfilling life, because it's not just about being rich, it's about what that wealth allows you to do, right?
Precisely. None of it as financial well-being, alongside mental, physical, and even spiritual well-being. They all work together.
Okay, so let's break down how we get there. One thing that really jumped out at me from all this research is how much emphasis is placed on mindset.
Yes.
It's not just about knowing what to do, it's about truly believing in your ability to become wealthy.
It's amazing how powerful that shift can be. If you're stuck in a scarcity mindset, seeing money as limited and hard to come by, that will actually shape your choices and opportunities.
So it's like a self-fulfilling prophecy almost.
Exactly. But when you shift to an abundance mindset, you start seeing money as a tool, a resource that can be used to create the life you want. You become more proactive, more open to opportunities.
I've even seen this referred to as the Quadri FIT Theory, where financial fitness is just one part of the equation.
Oh, yeah.
You have to be mentally, physically, and even spiritually fit to truly thrive.
That's such a great way to put it because think about it. If you're constantly stressed about money, it impacts every area of your life, your relationships, your health, even your ability to pursue your passions.
So true. Okay, so we've got the mindset piece down, but what about the practical side of things, the rules of the game, so to speak? Our research highlights this concept of an unfair advantage that investors have in the system. Can you shed some light on that?
Yeah, here's where it gets really interesting. Imagine our economic system has three main players: consumers, businesses, and investors. Consumers spend, businesses make profits, but it's the investors who are ultimately positioned to reap the biggest rewards.
So even though everyone uses money, the system itself is kind of tilted towards those who know how to invest it.
Exactly. And there are three key rules that really highlight this advantage. First, money flows to the investor. Second, inflation, something everyone fears, can actually benefit the investor. Rising costs mean businesses are bringing in more dollars, which flow back to those who own a piece of the business.
Okay, that's a perspective shift I hadn't considered before.
And the third rule, this one often gets overlooked, is that the tax code frequently favors investors. There are specific mechanisms that allow them to pay lower rates or have more deductions than someone earning the same amount through a salary.
Wait, are you telling me someone who invests their money could potentially pay less in taxes than someone working a regular job?
It happens all the time. There's a stark contrast between someone earning millions in a traditional job and someone like Warren Buffett, who derives most of his wealth from investments. Buffett can end up paying a much lower effective tax rate, even though his income is exponentially higher. It's a built-in advantage the system provides.
That's a lot to unpack.
Yeah.
But it also makes it clear why learning about these rules is so crucial.
Right.
It's like knowing them the big book before stepping onto the field.
Exactly. Knowledge is power, especially when it comes to finances. Once you understand the rules, you can start playing the game strategically.
All right, so let's say someone is listening to this and they're ready to get out of the financial danger zone, living paycheck to paycheck, maybe drowning in credit card debt. What's the very first step they need to take?
The foundation of any sound financial plan is an emergency fund. Aim for at least $2,000 tucked away, separate from your checking account.
Right.
This isn't about getting rich. It's about having that safety net so a surprise expense doesn't derail your entire progress.
I've heard that called your sleep well at night money.
Exactly. It takes so much pressure off knowing you can handle those unexpected bumps in the road without relying on credit cards or going further into debt.
And speaking of credit card debt, any advice for tackling that beast?
Aggressively, it might mean temporary sacrifices, cutting back on unnecessary expenses, maybe picking up a side hustle for a while. The goal is to throw every extra dollar you can at those cards until they're gone because that high interest, it's like a financial leak in your system.
It's not just about the money you're paying in interest, it's the mental energy it drains, right?
Absolutely. The source even mentions this idea of cutting Netflix, not just to save the monthly fee, but to reclaim those 2 hours a day. What could you achieve if you dedicated that time to learning about personal finance, building a side hustle, or even just de-stressing?
I love that perspective shift. Okay, so we've got our emergency fund, we're tackling debt. What's next? How do we start actually building a financial system that works for us rather than against us?
That's where the power of automation comes in. Imagine this. Every time you get paid, your money is automatically split into three separate accounts.
Okay, I'm intrigued. Tell me more about this three-account system.
The source calls it the 75-1-5-10 system. 75% goes into your spending account, covering essentials, bills, responsible enjoyment. 15% goes straight to investments, and 10% goes into a dedicated savings account.
So it's like paying yourself first, taking care of your future self before you even think about spending.
Exactly. And the beauty is, once you set it up, it all happens automatically. You're not relying on willpower or remembering to transfer money each month. It just becomes part of your financial ecosystem.
All right, so we're automatically saving, we're investing, but where do we even begin with investing? This is where a lot of people get intimidated, right?
It's understandable. There's so much information out there, it can feel overwhelming. But the first step is simply asking yourself, are you an active or a passive investor?
Okay, I think I need a little refresher on the difference between those two approaches.
Think of active investing, like being the captain of your own ship. You're picking individual stocks, maybe managing rental properties, actively making decisions about where your money goes. It requires time, research, and a certain level of risk tolerance.
So it's more hands-on, more involved.
Right. Passive investing, on the other hand, is like being a passenger on a well-run cruise. You're investing in funds, things like ETFs or index funds that track a specific market or sector. It's a more hands-off approach, ideal for people who don't have the time or inclination to actively manage their investments.
Got it. So active is more DIY, passive is more set it and forget it. But how do you know which strategy is right for you?
That depends on your personality, your goals, your risk tolerance. Some people thrive on the challenge and potential rewards of active investing, while others prefer the simplicity and lower stress of passive investing.
And I imagine you could even do a combination of both, right?
Absolutely. You could have a core portfolio of passive investments that provide steady growth over time, and then maybe allocate a smaller portion to active investments in areas you're particularly passionate about.
That makes sense. Diversification is always a good thing. Speaking of diversification when it comes to investments, do you prioritize cash flow or appreciation?
That's a great question, and it really depends on your individual goals and financial situation. Cash flow investments like rental properties or dividend-paying stocks provide a regular stream of income. It's like having a paycheck from your investments.
So that's great for creating passive income, maybe even supplementing your main income.
Exactly. Appreciation, on the other hand, focuses on assets that increase in value over time. Think of things like real estate or growth stocks. You realize the gains when you sell, but it might be years before you see that money.
So cash flow is about consistent income. Appreciation is about long-term growth potential.
Exactly, and there's no right or wrong answer. Some people prioritize cash flow for that sense of security and immediate income, while others are comfortable riding the wave of appreciation for potentially bigger returns down the road.
This is giving me so much to think about. Okay, so we've covered mindset, understanding the rules of the game, building a financial system, and even dipped our toes into the world of investing. What else is essential for building true generational wealth?
Well, next up, we need to talk about spending wisely. And this isn't just about budgeting, but understanding the fundamental difference between assets and liabilities.
Okay, I'm all ears. Tell me more about this distinction.
Think of it this way. Assets put money in your pocket, while liabilities take money out. A rental property, for example, is an asset because it generates income. A car, on the other hand, is typically a liability because it costs you money to own and maintain.
So the key is to focus on acquiring more assets and minimizing those liabilities.
Exactly, and one of the best ways to do that is to avoid financing liabilities, especially those unnecessary luxuries. If you can't buy it 5 times over, you can't afford. This helps you avoid debt and build wealth faster.
That's a great rule of thumb. It really puts things in perspective. But what about the other side of the equation? We've talked about saving and investing, but what about actually earning more money?
You've hit on a crucial point. You can only cut back so much. At some point, you need to focus on increasing your earning potential if you want to accelerate your wealth-building journey.
So we're talking raises, side hustles, building a business, all that good stuff.
Exactly. Saving the portion of a larger income is significantly easier and has a greater impact than trying to squeeze savings out of a limited income.
That's such a powerful point. It's not just about cutting back. It's about expanding your earning power. I'm curious, what are some of the most effective ways to do that?
There's no one-size-fits-all answer, but it often starts with identifying your unique skills and passions. What are you good at? What do you enjoy doing? Maybe it's asking for that raise, taking on freelance work, or developing a high-value skill that's in demand.
I love that. So we've got to be proactive and think outside the box when it comes to generating income. Okay, we're earning more, we're spending wisely, our investments are working for us. Anything else we need to consider on this path to generational wealth?
Absolutely. We can't forget about asset protection. It might not be the most exciting topic, but it's crucial for preserving everything you've worked so hard to build.
Okay, I'll admit, asset protection sounds a little bit dry, but I'm guessing it's important.
It's essential. As you accumulate wealth, you become more exposed to potential risks. Lawsuits, creditor claims, even family disputes can jeopardize your assets. That's why the research stresses the importance of having good legal counsel, expert accounting, and the right insurance coverage in place.
So we're talking lawyers, accountants, insurance brokers, the whole nine yards.
Exactly. They might seem like added expenses now, but they can save you a world of headache and potentially a lot of money down the road.
It's like that saying, an ounce of prevention is worth a pound of cure. Better to be prepared than caught off guard.
Exactly. And that preparation, that proactive approach is really at the heart of building lasting wealth. It's not just about luck or hitting it big. It's about making smart strategic decisions that protect and grow your assets over time.
I love that perspective. It really takes the fear and the mystery out of the equation.
Exactly. And it empowers you to take control of your financial future, not just for yourself, but for generations to come.
This has been so insightful. We've covered a ton of ground here today. Any final thoughts or key takeaways you want to highlight for our listen before we move on to part two?
Building generational wealth is a journey, not a destination. It starts with a mindset shift, understanding the rules of money, and taking consistent action. It's not always easy, but it's absolutely worth it.
I love that. And remember, even small changes can make a big difference over time. The journey to financial freedom starts with a single step.
Absolutely. Don't get overwhelmed by the big picture. Focus on what you can control today and build from there.
Amazing. Well, I think we've given our listener plenty to think about and digest. Be sure to join us for part two, where we'll explore even more actionable strategies and inspiring stories to help you on your journey to financial freedom. Until then, keep learning, keep growing, and keep striving for that life of abundance.
Yeah.
See ya.
Welcome back to our deep dive on building generational wealth. I'm excited to continue this conversation.
Me too. We laid a lot of groundwork in part one, talking about mindset strategy and taking action. Now I'm really curious to hear some real-world examples, stories that bring these concepts to life. It's one thing to talk about the theory, but seeing how it plays out in real life makes it so much more tangible.
You're absolutely right. So let's delve into a few examples from our research that illustrate the principles we've discussed. First, let's revisit those 3 key rules of money we talked about earlier. Money flows to the investor, inflation benefits the investor, and the tax code favors the investor.
Those were big ha-ha moments for me. But how do they play out in the real world?
Let's say someone decides to invest in a rental property. By becoming a landlord, they're stepping into the role of an investor.
Okay, so they're already engaging with that first rule, money flowing to the investor.
Exactly. Now let's say inflation kicks in and rental prices in their area start to rise. As the property owner, they have the ability to increase the rent they charge, bringing in more income.
So they're benefiting from inflation, which is usually seen as a negative thing. But for the investor, it can actually be advantageous.
That's the power of understanding these rules. Now here's where it gets even more interesting. Because they own a business, their rental property, they can often take advantage of certain tax deductions and strategies that aren't available to regular employees.
Whoa, so they're benefiting on multiple levels just by understanding how the system works.
Precisely. And over time, that rental income can become a significant source of passive income, helping them build wealth and achieve financial freedom.
I love that example. Okay, I need another story, something that really showcases the power of these principles in action.
All right, how about this? Imagine a young couple who decide to start investing early, even if it's just a small amount each month. They understand that time is their greatest asset, and they want to harness the power of compound growth.
That's such a smart move. Starting early, even with small contributions, can make a huge difference over time. But how does that translate into generational wealth?
They choose a simple, low-cost index fund that tracks the overall performance of the stock market. They're not trying to pick individual stocks or time the market. They're playing the long game.
A classic passive investing approach, low risk, steady growth potential.
Exactly. Now, fast forward 20 or 30 years, thanks to the magic of compound interest, their portfolio has grown significantly. Their initial investment, plus all the accumulated interest earned on that investment, has created a snowball effect.
It's amazing how quickly those gains can multiply.
Now they're not just thinking about their own retirement, they're thinking about how to pass on this wealth to their children and grandchildren, setting them up for financial success.
So it becomes a multi-generational legacy, not just a one-time windfall.
Exactly. And they don't just hand over a lump sum. They might set up trusts to protect the assets, educate their children about financial literacy, and involve them in managing the investments as they get older. It's about empowering future generations to be responsible stewards of wealth.
I love that. It's like they're creating a ripple effect that will impact their family for years to come.
Precisely. And these are just 2 examples, but they illustrate the core principles of building generational wealth. Understanding the rules of the game, taking consistent action, and thinking long-term.
Okay, those stories are super inspiring. But I know some listeners might be thinking, that's great for them, but I'm starting from scratch. I don't have a lot of money to invest right now. How can I possibly build that kind of wealth?
That's a valid concern, and it's where that mindset piece we discussed earlier becomes so crucial. It's about believing in your ability to achieve financial success even if your starting point is modest.
So it's not about how much you have now, it's about your attitude and commitment to the journey.
Exactly. Remember that couple who started investing small amounts each month? They might not have been wealthy at the beginning, but they were consistent, they had the right mindset, and stayed committed to their plan.
It's like that saying, the journey of 1,000 miles begins with a single step. It's about taking that first step and then the next, building momentum over time.
And never underestimate the power of knowledge. The more you learn about personal finance investing and wealth building, the more confident you'll become in making those smart choices.
Knowledge really is power, especially when it comes to finances. It can be intimidating at first, but the more you learn, the more empowered you feel.
Absolutely. So for those who are feeling overwhelmed or unsure where to start, what are some practical steps they can take right now?
That's the million-dollar question. What actionable advice can you offer listeners who are ready to move in the right direction?
First and foremost, tackle any high-interest debt you have. Credit card debt especially can be a huge drain on your finances. Create a plan to pay it down as quickly as possible.
We talked about that in part 1. Aggressively attack that debt.
Once you've got a handle on debt, create a budget that works for you, track your spending, and identify areas where you can cut back. You need to know where your money is going before you can make changes.
It's amazing how much money can slip through the cracks when you're not paying attention.
Then start investing, even if it's just a small amount. Take advantage of employer-sponsored retirement plans, or open a brokerage account and explore low-cost index funds.
Right? Make your money work for you. And remember those 3 separate accounts we talked about: spending, investing, and saving.
Absolutely. Automate your finances as much as possible. Make it easy to save and invest consistently without having to think about it.
Okay, we're paying down debt, budgeting, investing. What else should we be focusing on?
Never stop learning. Read books, listen to podcasts, take courses, immerse yourself in the world of personal finance. Surround yourself with people who are financially savvy.
I love that continuous learning is essential for success in any area of life, especially finances. The more you learn, the more confident you become in making smart decisions.
And finally, don't be afraid to seek professional guidance. Financial advisors, accountants, and lawyers can be invaluable resources as you navigate the more complex aspects of wealth building.
That's a great point. It's okay to ask for help, especially when the stakes are high. Sometimes having an expert in your corner can make all the difference.
Exactly. Building generational wealth can be a team effort. Surround yourself with the right people and leverage their expertise.
All right, so we've got a clear roadmap: tackle debt, budget wisely, invest, consistently keep learning, and seek guidance when needed. Is there anything else listeners can do to really boost their wealth-building efforts? What can they do to take it to the next level?
That's a great question, and it leads us perfectly into part 3 of our deep dive, where we'll explore some even more powerful strategies for maximizing income-optimizing investments and creating a lasting legacy.
Okay, now I'm really intrigued. What other secrets are we going to unlock? This is getting exciting.
Get ready to level up your wealth building game because we're about to dive into some advanced techniques that can truly transform your financial future. It's going to be a game changer.
I can't wait. Be sure to join us for part 3, where we'll unlock the next level of generational wealth building.
All right, welcome back to our deep dive. We are in the final stretch here talking about generational wealth. And last time we were talking about some pretty high-level stuff.
Yeah, we were.
You were teasing some even more powerful strategies for really kind of taking things to the next level. I'm ready. Lay it on me. Okay, so remember how we discussed the importance of increasing your earning potential?
Yeah.
Well, there's a world of creative ways to boost your income beyond just getting a raise or even a side hustle.
Okay. More money, more options, right? Tell me more.
Yeah, so one approach is to create multiple streams of income. Think of it as having several rivers flowing into your financial lake. And we already touched on passive income sources like dividend-paying stocks or rental properties.
Right. Those steady cash flows can really add up over time.
Exactly. But here's where things get really interesting. In today's digital age, you can leverage your skills and knowledge to create digital products or online courses.
Whoa, wait, you mean like turning your expertise into something that can generate income, kind of, on autopilot?
Precisely. Whether you're a master chef, a fitness guru, or a financial whiz, there's an audience out there eager to learn from you, and you only have to create that product or course once.
Okay, so that's incredibly empowering. You're not just trading time for money anymore.
And as you build these multiple streams of income, you're not only diversifying your earnings, but also creating a more resilient financial foundation.
So like if one stream slows down, you've got others to rely on. Got it. Okay, so now let's talk about optimizing investments. Any advanced tips there?
Well, one of the smartest strategies is to focus on tax-advantaged investments. And remember, we talked about how the tax code often favors investors. Well, there are specific accounts and strategies that can truly supercharge your results.
Oh, tell me more about these tax advantages. Because, everyone loves keeping more of their hard-earned money.
Yeah, absolutely. So for retirement savings, consider maximizing contributions to 401ks and IRAs. These accounts allow your money to grow tax-deferred. You don't pay taxes on the earnings until you withdraw them in retirement.
So your money's growing tax-free for years. That's incredible.
And if you're self-employed or even have a side hustle, look into setting up a solo 401k or a SEP IRA. They offer even higher contribution limits and more flexibility.
Okay, so those are great for retirement. What about investments outside of retirement accounts?
That's where things get strategic. One approach is to invest in assets that generate tax-advantaged income, like municipal bonds.
Municipal bonds. Those are issued by state and local governments, right?
That's right. And the interest income from these bonds is often exempt from federal taxes and sometimes even state and local taxes.
So you're getting paid and potentially avoiding a significant chunk of taxes. That's a win-win.
Exactly. It's a great way to boost your after-tax returns, especially if you're in a higher tax bracket.
Okay. I'm definitely adding municipal bonds to my research list. Any other advanced investment strategies you can share?
Let's not forget about real estate. We've already touched on rental properties, but it's worth emphasizing the tax benefits as well.
Right. We talked about cash flow from rentals, but there's more to it than that.
Well, real estate investors can take advantage of depreciation deductions. This allows you to write off a portion of the property's value each year on your taxes, even though the property is likely appreciating in value.
So you're essentially reducing your taxable income while simultaneously building equity. That's brilliant.
There are even strategies like 1031 exchanges, which allows you to defer capital gains taxes when you sell one investment property and reinvest the proceeds into another.
Okay, that one's a bit over my head, but it sounds like there are some serious tax benefits to explore with real estate investing.
There's a whole world of tax-advantaged investing strategies out there. Do your research or consult with a financial advisor to find what aligns best with your goals and risk tolerance.
Great advice. So we've covered maximizing income, optimizing investments. What about that final piece, creating a lasting legacy?
This is where it all comes full circle. Building generational wealth is about so much more than just money. It's about values, education, and making a positive impact.
Right. It's about building something that transcends your own lifetime.
As you build wealth, think about how you can use it to support causes you care about, mentor future generations, and create a positive ripple effect in the world.
So we're talking about philanthropy, mentorship, maybe even starting a foundation.
Exactly. And it doesn't have to be about enormous sums of money. It's about aligning your wealth with your values and using it as a force for good.
Wow, it really elevates the whole concept of wealth to a new level when you think about it that way.
And it brings us back to that idea of money being a tool. When used wisely and purposefully, it can have a profound impact on your life and the lives of others.
Man, this deep dive has been incredibly insightful. You've shared so much valuable information. Any final thoughts you want to leave our listener with as we wrap up this exploration of generational wealth?
Well, building generational wealth is a journey, not a sprint. It takes time, effort, and consistent learning and growth. But the rewards, both financial and personal, are immeasurable.
It's not just about financial freedom. It's about creating a legacy that benefits you and generations to come.
Absolutely. And remember, it all starts with that first step. Start small, stay consistent, and never stop believing in your ability to achieve financial success.
Awesome. Well, I think we've equipped our listener with a wealth of knowledge and inspiration to start building their own path to generational wealth. Any final words of encouragement?
Go out there and make it happen. The world needs your unique talents and contributions. Don't be afraid to dream big and pursue those dreams with passion and purpose.
I love it. That's a perfect note to end on. Thank you for joining us on this deep dive into building generational wealth. We hope you feel empowered to take control of your financial future. Remember, the journey begins today.